I just wanted to hop on here and talk as a new investor about why, when, where, who, how, and what to invest in, because I know that some of the hardest questions are just getting started. Once you get started, you kind of start snowballing the answers yourself and doing research, but that initial learning curve of getting started is something that could hold somebody back for years and years and years. So I just want to outline the reasons on why you should be investing, when you should be investing, where you should be investing your money into, how you should be investing your money, what you should be investing it in, and who you should be investing with / who can invest. So this is not financial advice. This is not telling you what to invest in or like what stock, for instance. You need to make your own plan. You need to figure out what you want to do with your money, and that is kind of what this video is about. It's just encouraging you to take that first step and do that, and why you should do it. So it's not financial advice. You shouldn't listen to anybody on the internet that tells you how to handle your finances, whether it's in the internet or in person, really. So a good example of why you need to be investing your money is just inflation. In 2021 to 2022 in Canada, we had a inflation rate change of between 7 and 8%. Let's just say 7.5, just for the sake of the video. And wages increased from $14.25 to $14.35, a 10-cent raise, and then again shortly after, it changed and rose to $15. Another small change of 4.53%, and a change of 0.7% the first time. So altogether, that's 5.23% that we got in minimum wage increases. At the same time, because we got those minimum wage increases and the cost of labor went up and the cost of producing goods went up, the cost of inflation also went up. Cost of inflation, as I said, went up by, we rounded it to 7.5%. 7.5 is bigger than the 5.23. So your wages did not even increase in that year, even close to the amount to even just fight inflation, never mind save money on top, pay bills, so on, so on. This is why it's important to invest. The increase in labor costs drove the prices of necessities up that year, and your same $1 that used to be $1 now needs to be $1.07 in order to purchase the same item. You lost 0.7 cents. You lost 7 cents of every dollar in your purchasing power. And inflation causes a company to raise the product prices because they pass the labor cost onto the consumer and have to pay the increased wages. So your $1 is really 93 cents now, and your $1 product is $1.07 due to the inflation. When you go to purchase it, it'll be $1.20 after sales tax. While your hard-earned money is worth less, you work harder for less and get taxed on the income too. So you're paying a portion of your money to the taxes, a portion of your money is getting eaten by the inflation, and the corporations are increasing their profits. So your purchasing power is becoming less powerful than it was as the dollar decreases. So that's all reasons why you need your money to stay valuable for you, and you've probably heard of concepts like gold doing that, which we're going to talk about. 42.3%. That's the amount of the yearly income that the average Canadian household pays in taxes. Not the elite, not the ultra wealthy or the 1%, just the average Canadian household. That means that just under half of your entire household's income is taken by tax. If you make $100,000 family income, $42,300 would go to taxes. An additional $7,000 to $8,000 would be eaten by inflation, roughly equaling $50,300 taken in your family income for the year. This is using the year 2021 and 2022 as an example, as we were before for the inflation rates. This means that more than half of your family income, more than half, is going to taxes, and an additional 7,000 to 8,000% would be eaten by inflation, roughly equaling $50,300, or a little bit more than half of your family's yearly income. This is using the year 2022 and 2021 as an example, as we were earlier for the inflation rates. Another reason is the rat race, which is the cycle the average person gets caught in. That is one of the most common hindrances to reaching financial stability and freedom. The rat race is made up of bills and living expenses, which race against us. As we know, the cost of living always rises. We feel it every day. It is made up of the taxes and inflation that we just spoke of, the company bonuses and pay raises that scarcely scrape inflation, as we just talked about. For the average Canadian from an average household, not the rich household, crazy 1%, just the average household, your personal experience with the rat race may look something similar to seeing your older brothers or family or cousins or uncles struggle to scrape by and pay the bills, or complain about their work-life balance, or complain about not enjoying their work, or seeing people around you overspend on things that they can't afford, and so on, so on. Those are all part of the rat race and factors of it, right? A very good example is usually your parents, considering they had you, so they have to pay for you somehow, right? They work, they pay their bills, pay taxes, they save. The savings and income often for many people don't beat inflation, don't beat taxes, and then when rent and other necessities and cost of life and groceries go up because the cost of labor goes up because we're paying higher wages, it just puts the pressure on, and there's nothing left to invest. And that's the rat race cycle, where you lose all opportunity with your money to move it into assets because you're stuck living paycheck to paycheck. And that's not anybody's fault. That's just the average experience here in Canada. So taxes take about half your income. The rest is squandered away on necessities like rent and water, which keep rising. Any emergencies will often have to be leveraged on debt, and any savings will be taught to not be spent. No need to keep up with the Jones or travel the world before you can afford to do so. Schools never really taught financial literacy, so your family couldn't pass it down to you. This is the essence of the rat race. It ends in debt, liabilities, instead of assets, and often leaves you stuck at a job that you do not enjoy because you literally cannot afford to leave it. This cycle leaves you living paycheck to paycheck with no leftover money to invest in order to escape it. This is the importance of investing, starting early, and the importance of acquiring assets. It is also important to enjoy what you do and try new things and become your own boss, because you don't want to be stuck doing something that you don't understand or you don't enjoy. And this is why schools should be teaching financial literacy, because people need to understand why they should be investing and need to understand that they don't need to always be an employee, and there's better ways to promote your own talents. So when it comes to when to invest, you should be investing as soon as possible. Always, often, once you are investing, you should never stop investing. The younger you are, the longer you have for your investments to grow, the longer compound interest can work its magic and work in your favor. You have longer to experience more risk, more market crashes. Market crashes become a buying opportunity for you in your 20s and 30s versus the emotional turmoil that you would go through in a crash if you're at retirement age. Markets will always pretty much rebound for you, since you have long-term time horizons once you're invested. And don't stop. Do not try to time the market. Every moment your money is not working for you, it is threatened by taxes, inflation, and your own spending habits. If you're 25 or under with very little expenses, for instance, if you live at home, then you should invest a large sum. If you have expenses, a house, car, kid, sick loved one, school debt, then create a budget of your monthly expenses, including bills, groceries, and anything else that costs any money for you, and then identify the leftover money that you have, if you have any at all. Not everybody does. That remainder of your money, if you have any, should go to assets and investing, and not liabilities and short-term pleasures through spending it and instant gratification. If you don't have a remainder of a budget, then you will have to learn new skills to increase your income or start a side hustle to bring in additional income. This is where becoming your own boss and enjoying what you do is very important to break that cycle and expose yourself to more income, to invest more, to create more wealth, and keep the cycle working in your favor instead of against you. And then where to invest? You should invest with a CDIC insured brokerage account. If it is your first time investing or you're young, I suggest using a TFSA, a tax-free savings account. which is actually an investing account and not a savings account, to capitalize on some tax-free gains while you're young. There's also other accounts with major benefits, such as the first home savings account and the retirement accounts, RRSP and RRIF, I think it is. Those also have major benefits where you get tax-deferred gains or so on. The first home savings account is an account that lets you save towards your first home through tax-free growth and tax-deductible contributions, tax-free withdrawal for your first home purchase, which is really big. For if you wanted to buy a home in like 5 years, that would be the case where you're not going to buy into a TFSA and you're going to put it into a first home savings account. You're going to get some really safe investments because you don't want it to go down in those couple of years, and then you're going to buy your tax-free home. The RRSP has tax-free growth, tax-deductible contributions, and a few other niche benefits for when you're nearing retirement. Doesn't really affect me, probably doesn't affect most of the audience that will be listening to this, but if it does, there's like a whole bunch of other accounts that are amazing for later in your investing journey or starting out for other goals that aren't necessarily just really aggressive growth like a young person would be doing. Well, you can invest at your bank. They do charge really hefty fees, and I would simply recommend opening an online brokerage that has low or zero fees. Interactive Brokers or Wealthsimple, for example. Some online brokerages even have welcome offers if you sign up with them. When it comes to how to invest, you should be, as we talked about previously, creating a budget to identify how much you can afford to begin investing with in the first place. It's a great first step. And you should be running that budget monthly to keep up with how much is going in and out of your accounts and expenses. Building your investment strategy and creating investment goals is a positive next step. You're going to need to do that before you begin investing. Identify your risk tolerance. That's part of your plan. When you need the money, creating emergency funds, and what assets you are investing in. For example, if you plan to purchase a home in 5 years, you may not want to buy volatile stocks inside of a TFSA like tech stocks. Instead, buy GICs or other more stable, safe investments inside of your first home savings account instead. You don't want that money to go down, as we talked about before, when you're about to buy your house and now you can't afford your house, right? If you have debt, create a plan to either pay it off or do the math to see if you can invest and pay off the debt at the same time. If you're younger, living at home with an excess of money and time, then you can invest more heavily and take more risk, investing in small caps or growth stocks rather than dividends to help you create growth. An 18 or 25-year-old can survive market downturns unscathed, using the drops as buying opportunities. Growth stocks tend to get hit hard during crashes, so if you're at retirement age, you may want to focus on retaining and protecting your wealth instead of trying to grow it with the risky, speculative investments like a younger person would. A retiree may want to look at bonds, GICs, dividends, high-yield savings investments, and currency hedges such as gold and silver. Create your plan, identify your budget, choose safe assets, invest what you can afford, create an emergency fund, pay off debt, and invest regularly to your schedule. Do not gamble on speculative stocks or options. Who is the investing class? The investing class is people that can afford it. Simply put, people that are uneducated on it. Not everybody is educated or can afford it, and that's partially due to school's fault not teaching us when we were younger, or teaching our parents, or the technology teaching as it's gotten better and better. So we haven't learned what the opportunities are, and because of that, we often don't trust the rich people. But we have access to some of the same tools that they do, and some of them are given to us by the government, like the TFSA, where you can invest. And many people are very skeptical of investing in crypto and stocks and so on, but it is what a lot of the wealthier people do because they hold assets rather than holding liabilities, and a lot of people don't understand that, and they would rather just spend their money to get use out of their money rather than put it in something where they fear it could be taken or rug pulled or crash or so on, right? We often just don't trust the rich or ruling class. However, if everyone invested instead, even just the people that put aside $5 or $10 per month, then we would have many more asset holders and a lot less consumers, and a lot more people would be better off against inflation we wouldn't have as many people that are struggling to get ahead because they aren't taught how to get ahead, right? That's really the only part that they're missing is the knowledge. Everybody has money at the end of the day. Everybody. You have to have money to pay bills and to live. It's just a matter of how you use that money and how you're going to pay off the debt to acquire the assets. Historically, only affluent people could invest, and schools have not taught updated financial literacy, so the stigmatization of the stock market as a rich people thing comes from a bit of truth. In the past, there was no online brokerage, there was no fractional trading, no exchange-traded funds, there was high fees to be paid to buy and to sell, and you had to have a certain amount of capital to even get a meeting with a broker. Meeting with your broker was an annual or semi-occurrence and cost money to have a broker, where you would, and in those meetings you would purchase your assets in a lump sum. There was no dollar cost averaging because you had to have a certain amount of capital to invest, and you were only meeting them once or twice a year. So if a stock tanked, then so did your money. Nowadays, none of that is true nor necessary. Online managed portfolios automatically manage your assets for you. Passive investing through dividends and exchange traded funds has never been easier, and you can buy any stock on almost any exchange at almost any time of day in some markets. Liquidity used to be an issue. Now you hit sell on an online app and it finds a buyer instantly. You can monitor and adjust your portfolio daily 24/7 and invest as little or as much as you want and can afford. Who you should be investing in is businesses you personally know and understand. A little bit of bias goes a long way, kind of like insider trading. If you work at a company and have a very solid understanding of its financials and its balance sheet and understand how the company is operating and where it's making its revenue and so on, you might have an inside scoop on an opportunity that most people don't even know exists. Otherwise, blue chip, well-known companies that have proven their business model like Google or Meta. Safe investments, such as ETFs and dividend stocks, are a great option that hold the entire market, and when something goes down, they kick the underperformers from the index and add in the next best thing. Most popular one that you're probably familiar with is the S&P 500 and the S&P 500 ETFs like VFE and VOO. So anything in that realm of safety that keeps you diversified into the market and keeps your money in assets that are consistently going up. They aren't necessarily liabilities that you're gambling on, that you're speculating on, that you're hoping is going to do something that isn't really predictable or based on a financial basis or a economic trend. You're not gambling options. You're not gambling your life savings. You're not gambling any leverage, taking any debt. You're not gambling more than you can afford, investing more than you can afford. It's not a casino. It's long-term growth. It's for retirement. It's not short-term to have $100 for next week to go eat, right? But yeah, if you're consistent with it and you keep at it, you will consistently keep beating inflation, meaning that every year when those bills go up, you will consistently keep having the amount of money that you need to live. And as your money keeps increasing due to the compound interest, you will have an excess amount of money that will provide for your lifestyle as it continues to grow. So you need to be investing as much as you can, whenever you can, as soon as you can, in what you understand, as much as you can, into the things that are the safest. So to round it out, you should be teaching yourself financial literacy, because the schools clearly failed to teach you or your family or your relatives it. That's everybody. That's not just you. That's everybody. So teach yourself financial literacy and pass it on. Make sure that you're investing once you understand and you've taught yourself. Make sure you're investing in safe, diversified funds. Make sure you're investing with an emergency fund in mind so that if something does happen, you have something to fall back on. Like 6 months of living expenses, 3 months of living expenses, whatever it is in your situation, so that if some emergency does happen, you can cover yourself without having to take a dip in the market or whatever it is. You should invest in ETFs that are safe, market indexed, and non-speculative. You should invest in blue chip stocks if you're investing in stocks, not speculative crazy penny stocks or crypto, and so on, so on. Not that there's not money to be made, but just as a beginner, you should really, really, really do your due diligence to make a portfolio, to understand what you're doing before anything, and that's what this video is about. So don't come at me for saying that you can't make money doing the things I'm telling you not to do. You just shouldn't do the things that I'm telling you not to do when you already don't understand investing. You should not jump into some of the things that are the most risky, that could make you lose the most amount of money. You should be trading inside of a TFSA. You should be trading inside of some kind of tax deferred account if it suits your goals. It doesn't need to be a TFSA. It just needs to fit whatever your goal is. So if you want to retire, if you want to buy a home, pick the account that you need. Don't just open a non-registered account and start paying taxes with no advantage. You are falling behind. Learn about how income is taxed through the stock market versus income through employment, and you'll learn how a lot of wealthy people survive off dividends or similar things like that, where they don't really need to work because they have such an excess of money that it just keeps them afloat and pays their cost of living and daily bills. So look into the things that are safe, that richer people do. Take advice from some of the people around you that understand better than you do. Don't listen to everybody. I'm saying talk to people that genuinely understand and know better than you do, and get some advice from them. There are people that have financial literacy in this world. You might just not be one of them, or your family, or the people around you. So find the people who are, even if you have to pay a little bit for it, right? Don't buy into a salesman. Don't buy a product. Don't buy somebody that's just trying to push something on you, which is hard when you're looking for a financial advisor. But if you need to pay for advice to understand what you're doing to get started, you have to pay for advice to get started, and make sure it's coming from a professional. Saving is not necessarily winning. We're taught to save all our life, and if we aren't introduced to a better way, like acquiring assets, then that's what we're going to do, and we are just going to get our money eaten away by inflation and wonder why we haven't kept up. This is the reality for a lot of our families, and this is why, even though they've done everything correct by the American dream or Canadian dream or whatever you want to call it, that they can't afford the things that they should be able to afford, because they saved, right? And that's not fair. So teach yourself that saving isn't necessarily enough. You have to invest and multiply and make your money work for you. That's very important. Another thing is, don't keep up with the Joneses. We touched on it super briefly. I listened back and heard that I kind of skipped right through it. It's a really important one as well. Don't go comparing yourself and keeping up with the Joneses. Don't think you have to buy a car just because your friend bought a car, or you have to buy an iPhone just because it came out, or a new PS5 just because your friends are begging you. You don't need to live outside of your means, and your means also means what you can invest. So if you're sacrificing what you can invest for quick pleasures like a PS5 and a Switch and alcohol and whatever other consumer goods that you're having to keep up with the Jones, then you're really just hurting your future self. And you don't want to play that comparison game, because you hop on social media, even with investing, and you see these large accounts, and you just want to start gambling to get up there. You compare yourself to the person who's smarter than you, or better than you, or looks better than you, or whatever it is. So you don't want to play the comparison game in the first place, and once you do, you don't want it to start impacting your money. So don't try to keep up with the Jones. So that's one of the main things that keep people back and keep them in the rat race. I think that just about covers everything that I had to say. And just remember that this isn't financial advice. You should only listen to the people that are well educated and professional that you are paying for. Thank you guys for listening, and I hope that it helps you in any way.